Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 4th of October and we have Jessica Amir, market strategist at moomoo, coming out to us from Sydney. Jessica, it's always great to have you on the show.
Happy Wednesday, Brian.
Now, Jess, before we get your insights, we're going to take a look and see how markets across the region have performed. But we start with cryptocurrencies. Bitcoin is at 27,400. It's down 0.83%. Ethereum is at 1,640. It's down 1.61%. Now, looking across the regional stock markets, we're going to start with Singapore. The SGX is down 1.41%, which is quite substantial. KLCI out of Malaysia is down 0.31%. Shanghai is all green. It's up marginally 0.1%, but the rest of the region continues the decline. The ASX is down 0.89%. The Nikkei is down 1.69%. The Hang Seng is down 0.96%. And rounding up the numbers is the Kospi, which is down a whopping 2.1%. Now, Jess, what's your view on market performance in the first half of the day?
Well, I think broadly we're seeing stocks pretty much pummeled by that strong US labour data that came out, basically strengthening the case for rates to stay higher for longer in the US. And ultimately that saw the 10-year and the 30-year Treasury bond yield, both of them roared up to around about 5%. And that's their highest levels since 2007. Plus we saw oil rebounding. It's back at just shy of $90. So I guess there's concerns about something breaking in financial markets. And that's already pushing a lot of the major indices, including in the US, to near correction territory. So you've got the major indices down almost 9%. Australia's ASX 200 down about 8%, while the MSCI Asia Pacific Index is down 9.4%. So a lot of concern in markets.
Now, just then, so as investors, what do we need to take away from all this market turmoil? What should we be doing?
Yeah, great question, because I think it's important that we sift through the noise. I think that we've got to remember when we do have higher bond yields at these levels, obviously the cost of business capital goes up. And we know cost of capital has risen very fast from almost 0% to 5% in a very short time frame. So that's obviously not good for companies or equities. And obviously a higher bond yield on offer is quite attractive because we've got these US bond yields that are paying higher yields than most in the world, so higher than the bond yield in Australia. And a boring bond is yielding more than the major US indices combined. So for the long term, while the Fed has got power to keep rates high for longer, I guess the catalyst is there for investors to move some money out of equities and into safe haven bonds. So also consider, Brian, we've got US earnings season around the corner, so you're probably going to see a lot of commentary about a murky outlook because companies are ultimately going to be grappling with higher for longer interest rates and implications of higher oil prices. So there's a lot to unpack for investors.
Okay, amidst all this turmoil, then where are the opportunities?
Well, I think it's good that we take a long-term view. So I'll just start out by reflecting on the words of Warren Buffett. When we have to look at the stock market basically as a transfer of money from the impatient, so those are selling, to the patient. So with that in mind, Buffett puts a lot of his efforts into finding undervalued securities. So that's what investors should be thinking and taking a longer-term view. So to that end, I think that you could see markets rapidly whipsaw higher once the selling ends, but obviously that's probably only when peak hawkishness, when that song is over, but who knows when that will be. But we do need to consider, Brian, at the moment the VIX index, it's around 20, so that's a level that the fear gauge was at back in March. And then of course we know what happened in March 2023. US markets rallied. Also the Fed is nearing the end of its cycle, its hiking cycle. So you could argue that pessimism is pretty high. We saw $2.2 billion being taken out of the S&P 500 SPDR ETF week on week, almost $2 billion out of the QQQ, $800 million out of the emerging market ETF week on week. So you're also seeing a lot of money go into, immediate term treasury ETFs, and 1 to 3 month treasury bill ETFs. So I guess it's fair to say, Brian, there's a lot of money on the sidelines, and you've got to consider long-term S&P 500. Over the past 5 years, year on year, it's gone up 12%. I mean, this is the only index in the world, Brian, that tracks profitable companies who have been consistently growing their profits over the past 4 quarters. So, I mean, we're looking at forward earnings. Just finally, forward earnings for the S&P 500, they're likely to be 6% and then 11 and 10%. So that's something to consider, because earnings growth drives share price growth. So the broad indices won't stay at these depressed levels for long.
Jess, you particularly and the folks at moomoo have been very bullish on the EV space. Are you still as bullish in terms of parking some of your money in this obviously long-term growth story?
Yeah, that's a great question. I think when we started off this chat today, we were talking about rates being higher for longer, and that's the rhetoric that's being echoed throughout markets. So we've got to think about what companies and sectors can continue to grow their earnings over the next 12 months on a strong earnings growth basis, enough to offset high interest rates, wages, electricity bills, oil prices, rents, without compromising their bottom line. And we do see, absolutely, the EV space being still underinvested and one of the most compelling generation shaping opportunities. So at the moment, this week, Brian, we saw US car maker production fall significantly, and that's something that's probably going to continue. Why? Well, we're seeing auto factory closures intensify across Ford, General Motors and Stellantis plants. So now 43 US factories are affected. That's 30% of US production pretty much down and out. But the silver lining here, just think about this for a second, is that lithium and copper prices have been pushed lower because there's obviously less demand, right? So the bottom line is, with lithium and copper prices being down, that's a fair chunk of capital spending for these EV names. So that's attractive for car makers' earnings. But you also have to think about EV penetration. It's gaining traction as well. So there's a lot of compelling momentum in this space.
Jess, thank you very much for your insights as always. Thanks for coming on the show.
Thank you, Brian.
Now, we've been speaking to Jessica Amir, market strategist at moomoo, coming to us out of Sydney on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out our interview on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.